Hello, and thank you for joining us today to walk through the performance evaluation presentation. This program was developed really in response to questions we get from advisors frequently on how can they find new sources of revenue with their existing client relationships, number one, and number two, how can they integrate it into their practice in an efficient manner. One of the challenges that advisors face is that anytime there's a new program that comes along, that generally means that somebody wants you to invest a lot of capital. Secondly, they want you to invest a lot of your time to get the training and get up to speed. And third, it may have limited application to your client base. In other words, it's just scope is not going to apply to everybody that you work with. Well, at the end of the day, virtually all of your existing relationships probably own some form of life insurance out there. The reality is that nobody has ever offered a service to step back and take a look and see if those policies are really doing what they were supposed to do, number one, and number two, are well integrated with the overall financial plan and strategy that you guys have put together for their investment portfolio. So that's what helps make this a little bit different approach. And when we look at the agenda here today, we're going to focus primarily on insurance as an asset class, have that conversation so that it ties in well with the overall idea of reviewing the asset portfolio that you manage. We're going to talk about what those risk exposures are for your clients, and we're going to talk about the value add service that you're able to provide with the pre-calc tool and performance evaluation report from DBS. Key resources that are available to support you and ultimately create and deliver a real win-win experience for you and your clients. So when we talk about insurance as an asset class, the question is it a valid statement? Well, the life insurance industry would say that it is. In the last 10, 15 years, it's been a very, very common theme that we've heard from carriers. The reality is they've tended to focus only on policy values and not so much of some of the other risk exposures, if you will, that we'll get into here in a minute. So if it is an asset class, what are you really doing to integrate it? And what proactive steps can you take to get there? Well, again, that's what we're going to address here as we start to walk through this overall presentation. Let's step back then for a moment and talk about the real risks that your clients face. Interest rate crediting. Policies that were purchased back in the 1990s and say early 2000s, interest rates, let's face it, were significantly higher in those days than they are now. Policies were based and priced on the assumption that those rates were going to carry forward into the future. No one really anticipated we would have the kind of low interest rate crediting that we've really experienced in the last 10 years or so. Well, that's going to have had a negative impact on the overall performance of the policy. And we'll talk about that in a little bit more as we go forward here. Mortality costs, of course, those exposures and expenses, I should say, are applied on an annual basis and deducted from the values inside the contracts. The expense charges, how efficient is the company in managing their overall business and delivering a good overall value to the client. Life expectancy is one that kind of sneaks up on us a little bit. I say that because it's kind of a two-pronged approach. One, the policies, again, that we were talking about purchased in the last 10, 15 years were based on life expectancies, many times projected out to be age 85 to 90, maybe sometimes to age 95. But they were all predicated on the current interest rate that was being credited at the time. Well, needless to say, if you've got a product without a guarantee in terms of the overall death benefit, you know that it's not going to have held up given that interest rates have continued to decline over time. So we've got a little bit of an issue there. Secondarily, even if the product has miraculously performed, we're kind of ignoring the fact that the segment of the population that you work with has a longer life expectancy than the general population. To get specific, if you were to remove the lower 25% of the economic strata, the remaining 75% have a life expectancy of about 92. Well, that's very, very different from the age 83, 84 life expectancy that we see from current tables that are out there. So you combine that with people living longer, lower rates credited to their policies. These contracts are running into a brick wall, and they don't even know it. The last point there is industry consolidation. As companies have combined and merged over the last few years, the question is, has the new owner been a good steward and provided an ongoing value proposition that was favorable, if you will, to the consumer versus the stockholder? These are some of the things we can get at. Here's a real life example of some changes that happened in November of 2016. Northwestern Mutual announced that they were going to increase their expenses generally. They didn't say by what amount, but they just said in-force policies were going to have a general increase in expense charges deducted from them. And they also went on to say that they were going to reduce the crediting rate 45 basis points from 5.45 down to 5.0. Again, given that policies that were sold 10, 15, 20 years ago, some of these crediting rates from Northwestern were north of 9%. So this is, a significant decrease, if you will. And it begs the question, are they alone? And the answer is no. There's lots of other carriers that have gone through similar reductions or increases in charges over time. In fact, virtually any carrier that has used current assumptions in their product pricing will have basically been exposing clients to underperforming contracts over time. And that's not to say that the industry was trying to bait and switch people. It's just that was the current assumption at the time, and ongoing market conditions didn't prevail. And we can see, again, it's pretty broad-based. You can see a 40 basis point reduction there from Mass Mutual, Guardian. Again, they've made a reduction of 20 basis points, and 45 there again with Northwestern. So what's this performance evaluation tool from DBS going to really do? Well, as I mentioned before, it's a turnkey process. We have pre-call letters that you can send to existing clients and even prospects. Scripted phone topics and comments to make to help get a call to action, if you will, to get the clients to move forward and bring the types of information that you'll need to be able to deliver this evaluation. We have the fact finders, the authorization forms, health questionnaires, and ultimately we're going to come up with about a 15-page report that gives a pretty in-depth analysis of where that policy is, or policies if they have more than one. Keep in mind there are minimums in order to get the full-blown performance evaluation. We require a $10,000 minimum premium. This would include 1035 proceeds coming from the in-force policies. So it's a reasonably met expectation or threshold, if you will, for most situations. The challenge, of course, is the time involved. So if you go to get in-force illustrations to get the full-blown performance evaluation, you're talking another couple of weeks or more to get those materials from the existing life insurance carriers. And most of the time that means you're making a phone call with your client to the insurance carrier to request the specific illustrations that you need. And you're doing all of this with no real idea as to whether or not you're going to be able to improve their overall position. So what we're saying is we think that there's a better way. And we think that there's an interesting way here that you can integrate this into your client periodic reviews. And specifically, what are we talking about? Well, we're trying to streamline the process and make it easier for you, and do so by setting up your client meetings with a couple of requests, if you will. Let them know that you have this new value add service that you can provide to help provide an overview of their in-force policies so that it integrates well with their investment portfolio, and also to confirm whether or not it's performing as they had originally intended. In order to do that, they'll need to bring a copy of their most recent policy statement. So they don't need a full-blown illustration, they just need to bring a policy statement. And by the way, that could include term policies. It doesn't necessarily have to be just permanent life insurance. And you want them to come to that meeting to have a conversation or be prepared to talk about why they bought each of those policies. And more importantly, when they get there, to have the conversation about, does that need still exist? So they get to talk a little bit about their overall expectations and need, if you will, when they originally purchased it and what their situation is like today. Confirm that the beneficiaries are correct. Many times you put together a plan, they set up a living trust, they set up other types of arrangements, and they never change the beneficiaries or the ownership of the policies. So those are the kinds of things you'll be able to talk about with the client. What's great about this process is that you really don't have to need to know a great detail about product design, product features, premiums, or whatever. These are just good basic questions to get into the conversation with your client and provide back to the DBS team. What we'll be able to do with that policy statement is to go back and apply it into a pre-calc tool that we have. So in other words, we don't really need a full in-force illustration at this point. We just need to be able to get the basics to determine whether or not we even have a potential or an opportunity to improve their existing situation. And we can also quickly identify whether or not the type of insurance they have is the new kind or the old kind. So what's the service standard for this pre-calc analysis? Well, you remember we were talking 2 to 3 weeks to even get an in-force illustration. We can deliver this the same day. So as soon as we get that policy statement, we can give you an update as to whether or not there's an opportunity to improve that client's existing situation. And what it delivers is guaranteed UL lifetime, guaranteed UL to age 100, and current assumption UL products. And we literally price it out with multiple carriers to see where that falls. If we see that there's an opportunity within one of those three, then we can talk about whether or not any one of those products is appropriate, or do we need to pivot to an indexed UL or a VUL or something else along the way. If we take the next step then and we actually do go forward with a performance evaluation, then we know that we're going to come back with a policy summary. We're going to have the overall review of the in-force contract, talk about the provisions, the ownership, and the beneficiary designations. A quick heads up on beneficiary designations, by the way. Do make sure you ask your clients what the beneficiary designation is on any employer-provided term life insurance. Very, very frequently we find that people, have this coverage provided by their employer and they haven't kept those beneficiaries up to date. There's been divorces, there's been marriages, there's been deaths, there's been all kinds of changes in their life, and they change stuff in their personally owned contracts, but their group stuff kind of gets overlooked. Well, what does that report look like? Well, this is a sample of the actual cover sheet, if you will, of the full-blown report. And as I said, this is about a 15-page summary of that client's overall insurance portfolio. The first thing that you should notice here is that there's no branding. You don't see anything on here about XYZ Insurance Company. This is truly a product agnostic solution, if you will, so that we come up with the best unbiased recommendations moving forward, as opposed to this is the best that XYZ Insurance has to offer. Well, what are some of the things that you think you might be able to do, or that you might be able to deliver to your clients? The first, we don't really give a lot of thought to, but the reality is many times we can improve the risk class that they have in the new policy. This is very common with people who use tobacco products. Maybe they chewed, or maybe they smoked a pipe on occasion, or an occasional cigar. Many carriers will treat that as a smoker, and that in and of itself will be equivalent to about a 4-table rating off of a standard life insurance policy for a non-smoker. So to just simply be able to get them into the non-smoker class is huge. That can save them a ton of money along the way. We can also identify whether or not financial ratings and stability of the existing company are still in check, so to speak, and have every reason to expect they're going to be able to deliver. And then we can also talk about alternatives that they might have in the marketplace to be able to continue to meet or improve in meeting their overall objectives. Some of the quick high-level stuff that we look at in alternatives is talking about, hey, what if we just took the same premium that you currently pay and we applied it? How much life insurance are we going to be able to provide? We might actually be able to get more coverage for the same money. We may also take the other approach that says the death benefit's fine, or maybe it needs to be a little lower. What's the premium required to keep that going? And the third topic, this is particularly true to discuss with your clients that are probably in their 50s and older, is that do they have that new kind or old kind of insurance? And specifically, we're talking about whether or not those policies have long-term care riders or chronic illness riders included. In short, this is a way you can help them find money to provide LTC benefits going forward. So at the end of the day, the win for your client with this new service is that you're able to confirm that they're meeting their goals and objectives, or that they can potentially reduce their costs, or that they can increase coverage. And again, as I said before, find the dollars for long-term care coverage and make sure the beneficiaries are up to date. And most importantly, that the insurance is well integrated with the overall portfolio. It's a huge win for your practice. There's no additional cost. It's really easy to integrate. It is, in fact, a proven turnkey process, and it will be a new source of revenue for you and your practice. To help drive that message home, we have in our overall turnkey package 3 different messages that can be delivered. One to those that have personally owned insurance, those that have trust-owned insurance, and then the last, employer or corporate-owned life insurance. Each one of these brochures delivers a specific call to action or identifies specific risks that the client has with the existing life insurance policies. And of course, as we talked earlier, virtually all of them, and especially the personal insurance, they have the cost of expenses, they have the interest crediting, and ownership issues and things like that we talked about earlier as to why it would be to their benefit to, again, take a look and have an overview of their policies made. In the trust-owned arena, it's a little bit different perspective. Back in the mid-90s, the Uniform Prudent Investors Act was passed, and it basically put the fiduciary at risk to basically demonstrate that they have managed the particular assets in a trust in an inappropriate manner, that they've demonstrated due care. If you have one of these policies that was priced and based on current assumptions, and interest rates have been crediting at a lower level, and expenses have possibly gone up, and life expectancies are longer than what they had been in the past, have you really brought that to your client's attention? Even though you've sent out the crummy letters, or you've sent out the premiums in a timely fashion, you've done everything that you were supposed to do, but did you do a review to see if the policy was going to perform? If you didn't, the courts have decided that you're at risk as the fiduciary, and yes, they have lost cases where they've actually had to make up the difference in the shortfall of the death benefit from just a simple life insurance trust. So If you know of a trustee, it's probably a good idea for them to get this type of service provided so that they can demonstrate to their beneficiaries and donors, hey, here is where the policies are, here's where the risks are you aware we need to make some changes, yes or no? They've at least demonstrated a degree of due care. In the corporate arena, where businesses can actually own life insurance policies on employees, there was a change in the law in 2006, specifically stating that if life insurance is purchased on an employee and the employee has not signed a notice of consent or waiver, that they know that the business owns the policy and is the beneficiary, then proceeds will be taxable to the business. And oh, by the way, the business needs to be filing an information form with their regular tax return, Form 8925, if they haven't even bothered to tell their accountant they're out of compliance and they don't even know it. The other aspect to keep in mind is if they did not sign that particular notice prior to the placement of the policy, in other words, the policy going in force, you can't paper over it. You can't go back to the employee and say, oh, hey, by the way, sign this. We need to document the file. The fact that it wasn't acknowledged or agreed to before the insurance went in force, shall we say, always subjects it to taxation. So the solution is the clients really need to reapply and get that waiver signed beforehand and get things moving in the right direction. And oh, by the way, tell their CPA so that they can actually get that form filed with their regular tax return and be compliant. So the question is, who are you going to meet with in the next 60 days that may benefit from the service? I'm thinking virtually any of your clients. It's easy to say, we have this new value add service. Well, it's also easy to go out and offer things. The question is, how can you deliver? And that's where you can count on the team at DBS. This is the team that's been assigned to you as an IFG advisor to help support you in providing the overall evaluations, the pre-calc tool, and the other resources within our organization. They're all well trained, know these products and services well, and can help guide you into the right direction so that you come out with a very, very solid and professional presentation for your clients. You're in a very unique position in that you have the confidence of the client, you have the relationship, you manage their money, you manage their main assets. Doesn't it make sense that you would have a conversation about this other asset class called life insurance to provide that service so that that is well integrated with what they have on a day-to-day basis with you, and create a true win-win? Because at the end of the day, the worst that's going to happen, you're going to be able to provide the assurance to the client that their policies are performing as expected and meeting their overall objectives. And at the end of the day, that's not a bad thing. Thank you very much for your time, and feel free to reach out to us. We'd be more than happy, whether it's one of the case design managers or whether it's a field relationship manager. We're all available and very, very anxious to help you move forward in this new endeavor. Thank you so much, and have a great day.